that works. Okay, yes, I'm going to record the webinar just in case any partners couldn't be here today or people that had registered couldn't make it in the end. So we're only going to have the recording available for a week because this kind of information does get old pretty quickly. It gets out of date very quickly. So we don't want it circulating out there in the internet for too long. So we're just going to have it there for a week for people to watch over the weekend or next week in the lead up to end of financial year. You should all, I think everyone knows me on here. So I'm Deline, obviously a financial advisor. And Andrew here, if you haven't worked with Andrew or spoken to Andrew before, he is an accountant, and you can probably guess from his surname, he's also my husband. But we have separate offices at home here. So Andrew says he can't throw anything at me if I'm being annoying. So the people that are on the call today have either received personalised financial advice from me or have tax advice from Andrew, but then so you might be here for a bit of a refresher. And then there are some people on here who haven't gone through the financial advice process but are looking to get started in the new financial year. So we thought we'd put this webinar on for those people who might want to have a look at what actions they might want to personally take before the end of the financial year. Now I'm going to try and share my screen and put the PowerPoint up. So just give me a moment. Okay, so can everyone see the screen and that's working? Awesome. So I do just want to point out that this is general advice only. It's not personalised advice. It's actually a lot harder to give general advice than it is to give personal advice because there are so many exceptions, so many different parts of the rules, so many different criteria and conditions. So we are trying to give information to a number of people today. So we're trying to pick out the bits or the bits of strategies that might be most of most interest. So it's not covering everything and it's not, personalised advice by any means. So it is just general advice today. But feel free to reach out if you do have any further questions. If you do have questions throughout this session, feel free to put them in the chat and I'll try and check them regularly. I will admit when Andrew and I were doing a practice run, I did get a bit distracted by the notifications. So I'm going to try to ignore those and just check on them regularly instead of trying to address them as we go through. And if you don't feel comfortable like talking or chatting through the system, through the Microsoft Teams, we can always talk afterwards if you like. So I think that's everything to start with there. Have I forgotten any housekeeping, Andrew?
No, if you also want to ask a question and you just don't want to butt in because Deline's pretty passionate and going down a rabbit hole on something, but just raise your hand and we can just ask you the question.
So things that we're going to cover off today. So Andrew's going to start off and talk a bit about some of the things you can do in the lead up to the end of financial year in relation to understanding your income, some different strategies around deferring income, prepaying expenses, a bit about the work from home deductions and how that's changing this year. And then I'll take over for the second half and talk about private health insurance, talk a bit about superannuation contributions, and then a couple of different resources to refer you to if you need to find out more information. So Andrew, over to you.
Okay, Deline, can you hear me okay?
Yep.
Okay. So first thing to know for everyone is, there's a lot to discuss and a lot to go into. Some of the topics that we looked at today is more about looking into your situation and as an individual, and these should be light bulb moments. So it's not really something that's going to you have to know everything about it and implement it yourself. It's go away and find a bit more if you want to do it yourself, or you just reach out and Deline and I can help you with it. So the first step is really to know your income. Do you really know how much you're going to earn this year? You know, do you know how much tax withheld? Is it enough? Are you going to have a bigger tax debt this year? So the first step is to organise yourself and know before 30th June, because you know the tax period is fixed, as in the period is fixed. You've got more options and more levers to pull before 30 June than afterwards. Deline, did you want to mention anything else about checking your income and the resources that are out there?
Yeah, something I often recommend people doing is maybe pulling out your last pay slip and having a look at what is your year-to-date income. And then also having a look at if you've got any like sort of side hustles or casual work and things like that, just getting an idea of what all that income looks like, if you've got investment income and things like that. And then you can actually go to a website called Pay Calculator and put in your income that you think you've earned for the year and get an idea of what your tax should have been for the year. So then that way, if you've got a pay slip, you can put in your income, you can see if enough tax has been withheld or if there has not been enough tax withheld. That can often happen when people like change jobs throughout the year or, you know, have had a bonus and things like that. So you just want to make sure that there's not going to be any surprises. And then that way it helps you plan for like what are your options between now and 30 June to help reduce that tax liability.
Okay, thanks. Deline, do you want to go to the next slide? One of the ways you can change your taxable position, and the tax office calls it your assessable income, is what you pay your tax on. So that's your net position after your deductions. Is you should really know, or tax planning should be done, or tax awareness is throughout the year. So events that might change what your regular income is, you know, when something or event happens, you should know that, okay, something's happening. It's a bit different to what normally happens. You know, should I do anything about it? And what can I do about it? Like, for example, you know, delaying income is pushing income into a different financial year. If you're going to earn less next financial year, sometimes it's beneficial to push that income, and if you can, to next financial year. And I'll give you an example. Are you maybe going to get a bonus from work, or you're going to get maybe a dividend payout from a business entity? You know, can you delay that to next financial year, or ask your boss to delay the payment till after 30 June? That's just one way to push it into a different tax year, which you might set as a different tax bracket. For self-employed or businesses, they will sometimes do this by just delaying invoicing clients and just pushing that to the different financial year.
So some of you may have not received an invoice from me, and that's because I'm maybe delaying the income till next year. But we have a question here from Roman. Did you want to take your microphone off, Roman?
Sorry, Andrew, I did promise I wouldn't ask any questions. I do have one.
Yeah, no worries.
Trust, and you distribute to significant others via the trust, can that, even though the trust might have earned in one financial year, if the distribution happens in the following financial year, what year does it count against?
No, distributions are treated a bit differently because it's done at the distributions made at 30 June, so it will count in that tax year.
Okay, thank you.
All right, Deline, you want to go next one? All right. So one, and we're going to get to just the deductible expenses. So this is also triggers. You're able to prepay your deductible expenses. So if you think you got larger income in this year, you can bring forward expenses that would normally be incurred in the next 12 months. So these are things that you might normally claim in your tax return. Can you bring any of those forward? Can you prepay your insurance premiums that are deductible in your tax return? Have you got an investment property? You know, can you prepay your interest on your loans? Do you need things for work, as in like computers, you know, smartwatches that receive emails? Do you need a new phone? If you think you're going to need it in the next couple of months, it might be beneficial just to buy it now before the end of the financial year. The important thing is also to take note is, you know, you don't go looking for expenses for for just a deduction's sake, do you really need those deductions or those assets? Because you don't just go and spend money for a tax deduction. Deline, you want to go to the next one?
100%. I was just going to say with the expenses, you don't want to, people say, oh, but it's tax deductible, but you're still paying, like if you're getting a 34%, 30% or 40% tax deduction on it, you're still 60% or 70% out of pocket for it. So it's not just because you're getting part of it back doesn't mean it's necessarily worth the expense. So just make sure you're only spending on things that you actually need, not just for tax purposes.
Okay. Here we go. Next slide. Some other options and to consider. Maybe it's for now. Maybe it's for the future. Does your employer offer salary packaging? And something to note is when you buy assets in your personal name, if they're over $300, you have to depreciate it over a number of years. So you might only get 15 days worth of tax deduction if you bought a computer now. But if you were to salary sacrifice it, like it's otherwise deductible or how it's termed, that if your employer offers it, they can salary package it as part of your normal salary and you get that benefit all in one. So that's very attractive. Another one, which is also part of salary packaging, is electric vehicles. And this is something new that's only come through the financial year. If you're considering on buying a car, and you don't mind the look in, electric vehicles is a very attractive option, and that's because of the FBT exemption. So it basically means it's like having another deduction in your tax return. If you were to go and pay for self-education expenses, you get a tax saving on that amount. The eligibility criteria is pretty specific. So if you're considering this, I just suggest that you talk to somebody so it's done right, so you're able to get the benefit from it. Deline, did you want to add anything there?
Andrew has a great presentation around electric vehicles and fringe benefit tax exemption. So if that is something everybody is interested in learning more about, he has presented that to some other businesses. So we were thinking maybe we could put that on in the new year as well, if you want to know more. So just reach out and let me know if that is okay. Yes, please. All right, we'll look into putting that on in the new year for you.
Okay. Some of the other deductions, if you have a higher income this year and you want to do it, is there any education expenses that you've been putting off or you want to do it? Can you prepay those, and just do the course next financial year? On the right-hand side of the slide, just some things to mention, and these are things that, Australian Taxation Office, might come and review you and your expenses. These are some of the questions that they'll ask you is, have you been reimbursed for these expenses by your employer? Because you can't double dip, why would your employer not pay for that expense? And then the other one is, which is normally the main test, is how does that expense relate to your income? So that's normally the main test, and the expense normally has to relate directly to your income or increase, or like with self-education expenses, lead to an increased earning capacity as well. Next one, Deline. The one thing that I wanted to mention is work from home deductions, and there's been a change here, and that change came through on the 1st of March. With working from home and COVID, working from home expenses is really popular in tax returns at the moment. And there's two main methods. One is the actual method, so what you actually spent and your business portion claimed in your tax return. And then the other one is, they call it a shortcut method. And that's a cents per hour worked from home. And if you look at this table, it used to be 52 cents, and that phased out in June 22. Then it went up to 80 cents, and that ended up last financial year. And now from onwards, it's 67 cents. So they've reduced the rate that you can claim, and they've also pulled in a couple more criteria as well into it. So basically the rates changed, and they're also getting a bit more picky on what record keeping requirements you need. And we'll go through those in the next slide. From the 1st of March, as I said, the tricky one is they want actual records of all the hours that you've worked. So before that, so from 1st July to end of February, you would normally just have to have an estimate of your hours you worked from home. Say you would normally just work 3 days from home or 1 day from home, and you keep a 4-week diary, and that's good enough. But that means from March, April, May, June for this financial year, and now moving forward, you have to have a more accurate record. So it might be something that your employer has put something in writing that you work home these days, and these are your normal hours of business. It might be recording it in a diary or your calendar as such, so you can get an accurate record if you're asked for it of the actual hours that you've earned or worked. That's all I was going to mention for that, Deline. Oh, one more thing on the working from home deduction is what I normally do when I run through with clients is that we do the calculation as an estimate on how much using the shortcut method on how much we can claim. And you always compare that versus the actual method, so the business percentage used. If you work more than 2 or 3 days from home, it's normally the actual method turns out the more beneficial method with a higher deduction. But at least you've got 2 options to compare. The other point to talk about is private health insurance. So if you haven't got private health insurance and you have events that might increase your income over these thresholds, and these are the new thresholds, something that you definitely need to consider and look at. And that's not only now for this end of financial year, but moving forwards, if your situation does change and your income does push you into those brackets, it's definitely something that you think of, because the tax that you pay could be paying for your private health.
Yeah, so essentially, if you think you're going to be hitting these base thresholds, you may want to look into private health insurance, so you're not having to pay a Medicare levy surcharge. So everyone has to pay Medicare levy, well, basically everyone. But then this is an extra Medicare levy surcharge, and it is based on how many days in the year you hold private health insurance for. So you may not actually get much benefit taking out the cover now in this, in these last couple of weeks, but you might have had some pay rises throughout the year that mean that next financial year you're going to be in a higher bracket. And while Andrew and I, private health insurance is actually considered a general insurance product, so it's not something we can make recommendations on that product, but we can refer you to a broker who specialises in that area if you want to review your existing cover to make sure that it is still competitive and the definitions and things like that are appropriate for you, the quality of cover, or if you need to take out cover as well.
Okay, thanks.
So now over to me. So everyone knows I love to talk about superannuation. So a lot of people think end of financial year ends on 30th of June, when actually it does go into July as well, because we need to make sure we're setting ourselves up correctly for the next financial year too. So far, Andrew's been talking about things you can do up to 30th of June. And what this slide is all about is just letting you, educating you to understand what your income might, how your income might change in the new financial year. Super guarantee is expected to go up. Well, it is going up from 10.5% to 11% in July. So you need to understand, how is your salary structured? Are you on a salary package where it's your salary inclusive of super? Or is it salary plus super? And the reason that matters is because if you are a salary package where it's inclusive of super, your take-home pay might be reducing in July because an extra 0.5% will be going into your super. So in the top box here, you can see if we had an $88,000 salary, including 10.5% super, net income in June would be $5,137 for the month. Whereas in July, because of that extra 0.5% of super, the take-home pay is reducing down to $5,120 for the month. The other option is if you are getting a salary plus super, then you'll be getting a bit of a pay rise in the new year. So an extra 0.5% going into your super. So it's just being aware of how that might change your take-home pay in the new financial year. So I'm going to talk a little bit more about tax-deductible contributions to super. Before I do get into that, just some things to keep in mind. First of all, whenever you put money into super, it is preserved until you meet a condition of release. So generally that means you have to get to at least 60 years old and be retired before you can access the money. That's as a general rule. There are caps on how much you can put in, and you do need to make sure the money has been received by your super fund before 30th of June to be able to claim that as a deduction in this year. So most super funds are saying that if you're doing a BPay contribution, that should be done by the 23rd of June to make sure it's had plenty of time to be allocated by the 30th of June. And then with each of the different types of contributions we go through today, there's different rules and criteria to be eligible for the different benefits. So the first one I want to talk about is deductible contributions to super. This one is one of my favourite deductions because like when we're talking about buying a laptop or, prepaying an expense, you're paying money for something and it's kind of going in an expense. Whereas when you make a tax deductible contribution to super, you're still getting to keep that money for your retirement. So it's still your asset, still your money. So that's why it's one of my favourite deductions. Essentially, the way tax deductible contributions work to super is we can have $27,500 go into our super under the concessional cap. That concessional cap includes employer contributions, salary sacrifice, and then also any contributions you put into super that you claim a tax deduction for. The reason these contributions are tax effective is because if you are normally taxed at, say, 34.5% or 37%, when you put that money, you sacrifice it and you contribute into super, you're only being taxed at 15% on the way in for the majority of people. So the way this contribution practically works is you can put a BPay contribution into super underneath that 27,500 cap, and then taking off employer contributions and salary sacrifice. And then when you put that BPay into your super, you need to complete an S290 form, which is a notice of intent to claim form. So you need to tell your super fund with that form that this is going to be a tax deductible contribution. So they can take out the 15% tax and send that to the ATO. And then they'll send you a letter or an email to say, we acknowledge that you have turned that into a tax deductible contribution. And then you have that proof that you can now put that into your tax return when you do that in July, August, September, whenever it is. And actually claim that as a tax deduction in your tax return and get hopefully a decent refund when you do that. Just something to bear in mind with this type of contribution, though, is depending on how much income you earn, there could be something called a Division 293 tax. And what that one is essentially all about is most people only pay 15% tax on their super contributions. But if you earn more than $250,000, so it's taxable income plus super contributions plus reportable fringe benefits. There's a whole heap of things that go into that $250,000 calculation. But if you earn more than $250,000, your super contributions will be taxed at, well, some of them or all of them will be taxed at 30%, not 15%. And so what will happen is when you do your tax return, the ATO will issue you a Division 293 tax and say you owe us some extra tax on your super contributions, and you get taxed at 30% instead of 15%.
Deline, with that one, it's obviously if you're already at the high tax bracket, it's better to pay 30% tax than 45%.
That's right. Now, there is another special rule with these concessional contributions, and this is some new legislation that came in a few years ago, about 5 years ago. It's for people who have total super balances below 500,000. Now, to find out your balance, if you had a total super balance below 500,000, you actually need to look at what your balance was on the 30th of June last financial year. So 30th of June 2022, you can log into your MyGov account and have a look to see if you're below that threshold. And if you are, you might be able to do something called a catch-up concessional contribution or a carry-forward concessional contribution. And what that essentially means is if you haven't used your total concessional cap in the last few years, you can carry forward some of those unused amounts and use them all now. So in this example on the slide here, you can see that the cap used to be $25,000 a year, and then it went up to $27,500 a couple of years ago. And in this example, if we assumed in the first 3 years, the used amount was 15,000, there was 10,000 remaining. So essentially right now, this particular example is showing that somebody could make a $45,000 tax deductible contribution into their super this year. This contribution carry forward amount is only available for up to 5 years. So it means that next year will be the last year that you can use a 2018 to 19 financial year unused amount. And then after that, it's going to expire and kind of drop off because you can only go back over the last 5 years if you have a total super balance below 500,000. Now, this type of contribution is a non-concessional contribution. So we can only put in up to $27,500 per year as a tax-effective contribution, unless you've got those carry-forward amounts. This one here is a non-concessional, so you don't get any tax benefit for putting this type of money into super. But this type of contribution might be suitable for somebody who has sold a lumpy type asset like a property, or has received an inheritance, or maybe has their own business and they're thinking about maybe buying a property inside a self-managed super fund and they're trying to get some more money into super. Because the benefit of putting money into super this way is that the investment earnings you generate on this money is taxed at a maximum rate of 15%, rather than if you had that same investment outside of super being taxed at your own tax rate, you could be paying up to 47% tax. So I don't think a lot of people on here would be utilising these contribution caps, but I just thought I'd put it in there today just in case.
Deline, what I sometimes tell people is, people get confused with the word concessional. Sometimes I sub out concessional and put deductible in. So when they talk about non-concessional, I know it's because it's concessionary tax, but so it's non-deductible.
This is non-deductible, that's right. One of the reasons somebody might use one of those non-deductible contributions into super is to get access to the government co-contribution. So this one here is available for low to medium income earners. So if you were earning between $42,000 and $57,000 for the year, if you put in $1,000 into your super, the government will match up to $500 as a co-contribution. So if you earn less than $42,000, put in $1,000, the government will give you $500. That is a 50% return on your money, essentially. So it's a pretty good return. But then once you're earning more than $57,000, you're not eligible for this contribution. The other criteria in relation to co-contributions is that 10% of your income needs to come from work-related sources. So you couldn't just be getting your income from like investments and that's it. You do need to have at least 10% from business, or like a self-employed business or an employee role. So this type of contribution is really great for people that might be on like parental leave or taking a career break of some sort because they might have only worked part of the year. And this goes back to why Andrew said at the start, you really need to know what your numbers are before you start, putting money into super or, spending money, because you need to know where you're going to end up as to what your tax rate's going to be. Now, this type of contribution, a spouse contribution, is not as great as the co-contribution, because the way this one works is if you've got a partner and you've got a difference in income levels, so you might have one person earning good income, high income, the other person in the relationship's earning a lower income between, under 40,000 essentially. Then the higher income earner can put up to $3,000 into their spouse's super, and that higher income earner can get a tax offset of up to $540, which is an 18% benefit. So it's not as good as 50%, but this one here doesn't have the rules around having to meet the 10% work income. So this could be, I've seen couples where there is one person's at full-time paid employment and the other person is receiving like investment income because they've structured all the investments in the spouse's name. So they might qualify for this type of contribution. Now, spouse splitting, the way this one works, it's a pretty underused strategy these days. So what it essentially allows you to do is split some of your contributions to your spouse's super. And so the reason you might want to do this is to create some equalisation in the super balances. There might be a big difference between you and your partner's super. Also, if there's difference in income. So you might want to boost one person's super a bit more, but because they're not earning as much income, it might make more sense to do all the tax deductible contributions into the higher income earner's name and then split the money into the spouse's super. So the reason we want to equalise super balances a bit more these days is because there is a cap on how much you can have in super as a tax-free retirement income stream. It's currently 1.7 million and it's going up to 1.9 million from the 1st of July. So that's 1.9 million each. So it's still quite a lot of money, but we just don't know what those caps will be in the future. We don't know if they'll be reduced or if it will change. So I think that's why it is quite prudent to consider equalising super balances. Another reason might be because there might be a big age gap between spouses. And so if you've got like a 10-year age gap, for example, the younger spouse might want to put that into their older spouse's super so you can get access to that money sooner and have access to it tax-free sooner. So there could be a couple of reasons there. To do that one, you essentially need to speak with your super fund and get a form filled in to do that. So that was the end of the super contributions. Did anyone have any questions? I haven't seen any come through. I've been trying to keep an eye out on the other screen there. If not, there is a couple of resources that we can refer you to. So number one is going into your MyGov account, and inside your MyGov account, you can go to your tax portal. And inside there's a section on your superannuation. So you can see what your total super balance was on the 30th of June last year. You can see what your unused carry forward contributions are, and find out all that information if you are looking to do any of those tax deductible contributions. There is also a super contributions calculator, an optimizer calculator on the ASIC Money Smart website. And there's lots of great tools on that website, actually. I use it all the time, but sometimes people are not quite sure if they're like in between brackets what the best type of contribution is. So ASIC's Money Smart website can help you identify that. It's obviously not taking into account your entire situation in terms of like, do you need that money for, your mortgage or other goals? But if you're quite clear that you're wanting to boost your super, this could be a tool that helps you. So we've finished up a bit earlier than we expected. Does anyone have any questions there? If not, we'll let you have an early mark.
Thank you, everybody, for joining us today and taking time out of your day.
I do just want to say as well, I forgot to mention at the start, Bianca's on the call as well. So Bianca actually just passed her 3-month probation with Mazi Wealth. So you might get emails from her in the future if you haven't already heard from her. So I was just meant to let you know that she is part of the team and passed probation this week, which is excellent. I'm happy to have her on board. Alrighty. Well, I hope everyone has a good day. Feel free to reach out if you've got any questions. Speak to you soon.
Thank you,
Bye.
guys.
Thank you.
Thanks. Bye.
Is Bianca a financial advisor as well, or is she another part of the team?
Yeah, sorry, I should have clarified that. She's a client service officer, so she helps with implementing advice and helping onboarding people to get their initial advice, so helping with the more administration type work.
Lovely. Very good. Thank you.
Thank you.
The recording's still delayed.
I know, I'm trying to figure out how to stop it. Stop it. Okay.